Hello, this is the Strifor channel. Here we speak honestly about markets, price logic, and real trading. If you want to think rather than guess, subscribe to the channel, and for live practice and fresh news, check out our Telegram. That's where the essence of trading lives. Market makers have become surrounded by more myths than any other market participants. Some consider them demigods who can see all retail traders' orders and deliberately manipulate the crowd. Others blame them for every failed trade. I got stopped out because the market maker wanted it that way. The internet is full of conspiracy theories about how big players deliberately move the market against small traders. But is this really the case? Who are they really? And is it true that everything in the market is rigged exclusively in their favor? Today we'll examine in detail who actually is a market maker and what their functions are, how they make money and why they need constant liquidity, why their perfectly logical actions are often mistaken for manipulation, and most importantly, how to understand their behavior and use this knowledge to your advantage. Let's start with the definition. A market maker is a market participant who has taken on the obligation to maintain liquidity. They constantly place buy and sell orders simultaneously. For example, they're ready to buy an asset at 99 and simultaneously sell at 101. This 2-point difference is their main source of income. It's important to understand, market makers don't profit from market direction, but from 3 things: spread, trading volume, and price stability. Their main task is not to predict where the market will go, but to ensure trade execution is possible at any moment. Therefore, market makers are most often large investment banks like Goldman Sachs, JP Morgan, specialized trading companies and algorithmic funds, exchanges themselves, or brokers acting in the exchange's interest. High-frequency trading firms with powerful algorithms. Each of them has contractual obligations to the exchange to maintain the spread within certain limits and ensure minimum liquidity volume. Myths are born from emotions and misunderstanding of market mechanics. Imagine this situation. A beginner trader opened a long position, placed a stop loss under an obvious support level. The price reaches their stop, knocks them out of the position, then reverses and moves in the originally planned direction, upward. What does the trader think? This was intentional. The market maker saw my stop and decided to knock me out. But reality is much simpler. Most traders' stop losses are placed in the same obvious places: under support levels, above resistance levels, behind round numbers. Market makers don't hunt specific small traders. It's economically unfeasible. They simply find it profitable to collect liquidity where it exists. Movement towards stop-loss clusters isn't a conspiracy against retail. It's pure economic logic. That's where concentrated volume is, meaning liquidity for large trades. Additionally, many don't understand the difference between market makers and large speculators. Hedge funds that trend trade aren't market makers. They're regular market participants, just with larger capital. And if you want to not just listen to market stories but actually trade, start with the first step. On the Strifor platform, you can create an account in a couple of minutes, complete simple verification, and get access to over 250 instruments, from currencies and metals to cryptocurrencies and indices. This is a working environment where everything is optimized for practice. Demo account, transparent commissions, fast trading, and support in 3 languages. Link is in the description. Start your trading journey consciously. To understand market maker behavior, you need to understand their business model. It's fundamentally unprofitable for a market maker to have the market sharply move in one direction without stops. Why? Because this disrupts the balance of their positions and increases risks. Their ideal scenario is to keep the price within a certain range, gradually accumulate liquidity from both sides, and only then facilitate movement in the direction where there's real interest from large clients. This is exactly why markets so often experience false breakouts of important levels with quick returns, systematic stop-loss hunting before real movement begins, price returns to trading ranges after sharp impulses. This isn't manipulation in the conventional sense. It's fuel collection for further movement. Let's say a market maker sees that 80% of market participants are bullish and have already bought. What will they do? Logically, first show a decline. Why? To shake out weak hands, force panic selling, collect this liquidity, and only then, having sufficient fuel, facilitate real upward movement. This is rational behavior aimed at profit generation, not warfare against small traders. The retail trading crowd leaves very predictable traces in the market. Identical stop-loss placements, always behind textbook levels, volume clusters at psychologically important marks, mass positions during overbought or oversold conditions according to popular indicators, template reactions to economic news and events. Market makers don't read the minds of retail traders. They simply have data. They can see where orders cluster, where stop losses are placed, what volumes and in which direction come to the market. And they use this information most efficiently. They see stop-loss clusters below a level. They move price there to collect them. They see everyone buying on a breakout. They show a false breakout and collect stops from those who believed. Essentially, market makers don't fight the crowd. They use it as a liquidity source because the crowd's emotional reactions create exactly the liquidity they need for business. This is symbiosis. The crowd gets the ability to trade, liquidity. The market maker gets profit from this trading. Understanding market maker mechanics allows you to consider opportunities for improving your trading. First consideration, try not to be predictable. You could try not placing stops where everyone places them. Perhaps avoid entering trades just because everyone's talking about them in chats. It might make sense to consider alternatives to trading the most popular setups. Second consideration, it may be useful to observe the reaction, not just the fact of level contact. A resistance breakout can be viewed not as an automatic buy signal, but as a reason for analysis. Pay attention to what happens after. Is there consolidation above the level? Is volume increasing? Or is this a false breakout with quick return? Third consideration, you could try looking for asymmetry between expectations and reality. Where the majority expects growth and has already bought, the market maker might stage a false decline to collect stops. Where there's panic and everyone's selling, quiet position accumulation often begins. Fourth consideration, it's probably worth always looking at volume and market context. Abnormal volume appearing after stop-loss hunting can often be more important than simple geometric contact with support or resistance levels. Fifth consideration, it might make sense to work through scenarios, not signals. Instead of searching for a holy grail indicator, you could try building hypotheses about possible price behavior and test them through market reaction, not through your desire to profit. If you're a beginning trader, here are specific steps you might consider. First possible step, you could try comparing crowd expectations with actual price behavior. Perhaps it's worth reading trading chats, watching popular indicators, studying news, and comparing this with what actually happens on the chart. Second option, you could try marking levels on the chart where mass stop-loss collection is probable and observe how price reacts to this. Often after such collection, impulsive movement in the opposite direction begins. Third approach, it probably makes sense to trade only where you understand the overall market structure and have clear confirmation of your hypothesis through price behavior. Fourth consideration, you could try learning to think like a counterparty, not as a player at the table, but as the organizer of the game itself. Perhaps it's worth asking questions. Who benefits from the current movement? Who might be interested in trend change? And perhaps it's worth considering keeping a detailed trade journal with comments on your emotions and expectations. This could help track moments where you react like a typical crowd representative and correct your thinking. Market makers aren't enemies of retail traders. They're an integral part of the market ecosystem. It's thanks to them that you can open and close a trade whenever you want. But along with providing liquidity, they dictate certain rules of the game. And if you want to not just survive, but also profit, these rules need to be understood and used. Observe the market, analyze price behavior, adapt to big players' logic, scenario thinking, sober situation assessment, and the ability to wait for the right moment. These are the real weapons of a successful trader. If you want more such practical breakdowns, subscribe to our Telegram channel. That's where the essence of trading lives, without illusions and rose-colored glasses. Only real market mechanics. Trade not with emotions, trade with meaning. See you in the next video.